Hey everybody, Kevin here with another episode for you of the Real Estate Without Renters podcast. Thank you so much for listening to the show. And please go ahead and hit that subscribe button if you haven't done that. And if you do enjoy the show, please go ahead and give me a nice 5-star rating there. That does help. It gets more exposure, attracts more sponsors, and enables us to do a lot more of these podcasts. I say us today because I'm joined by my friend and colleague, David Frenicky. David, how are you?
I'm doing great, Kevin. How are you?
Excellent. Thanks. Joined with David because we're doing this special series. And in this series, if you haven't listened to the previous episodes before, I encourage you to do so because we've addressed the issues of inflation and mortgage crisis and property valuation and so many different things that are very, very topical and important to you today as a real estate note investor, that you should go back and listen to those. But the information's constantly evolving. There's new numbers coming out. Some things are getting better. Some things are stabilizing. Some things are showing signs that they're getting worse. And as always, we want to point those out to you because both David and I have always believed as investors, especially in the real estate and real estate note business, risk first. Identify your risk. And then you look at your reward. You have to pay attention to your risk tolerance. So all these issues of possible declining prices, mortgage crisis, all of these things are important to us as real estate investors. But if you're exposed to them, if you understand the issues, you have much better chance, a very good chance of navigating your way through that landmine field to get to the other side and make it profitable. Because with all these problems comes opportunity. And every time we do these, we point out the negative things, but we always wrap it up with the positive, right? And that's something, Dave, that you and I have always looked at because we've been through these cycles before, right?
Yep. And on our pre-call prep, Kevin and I were talking about, said, okay, we're going to be talking about all these things. And people might say, oh my gosh, the world's going to fall in. But I said, there's opportunity and there's ways to work around this and make more money. I am salivating at the opportunity coming up now in the next 2 or 3 years. That's my little 2 bits, Kevin. Go ahead.
All right. Sounds good. Now, again, we're doing a dual podcast on this. And what I mean by that is if you're listening to this on your iPhone or some other device such as that, and you're listening to audio only, that's great. I appreciate that very much. If you like to see the video portion of this, then just jump on over to YouTube, look for my channel, just search my name, Kevin Shortle, and you'll find my channel and go ahead and subscribe to that as well. And that way you'll see the PowerPoints that we use and everything else, because this series does involve some PowerPoints, some articles and things like that that I think you will want to see. So if you're listening on the audio and want to look at the video later, you can do that. If you're watching this on YouTube first and you want to just get audio only or driving in your car, you can do that obviously through the podcast as well. So this is broadcast wherever you get your podcast done. So David and I will be very descriptive on the slides because we are sensitive to the fact that some of you do not have those visual aids right in front of you. Okay, David, so the topic I want to talk about today is based upon an article that came out in Bloomberg just a few days ago. So I'm going to share my screen here with everybody. And this article in Bloomberg, you can see right in the main headline here, the article's titled, U.S. mortgage lenders are starting to go broke. That's the big headline on Bloomberg. And that's a pretty frightening headline. It's certainly an attention grabber. But as I was reading through this article, it dawned on me that I have addressed this issue before. So I've been scrambling for 20, 30 minutes, Dave, looking for this old PowerPoint that I created. I finally found it. It was back further than I thought. I looked up this article this PowerPoint that I put together back in October of 2018. And the seeds of this were in that PowerPoint presentation in that video that I did. And by the way, everybody, before we jump into it, if you go to my website and click on blog up here, there's a lot of good blogs. I stopped blogging around 2020 in May because I've switched over to the platform with podcasting here. But previous to that, I've got articles that go back, blogs. These are all video blogs that I've put on here all the way back to 2018 and addressing a lot of things such as student debt, which is coming up again. So pretty interesting to go back and look at those. So if you haven't seen blogs on my website, check that out as well. But this headline, pretty scary, David. So we have to address this, and I thought we might go through this article a little bit to point out some things. But you surprised by that headline at all at this point?
I am not, and here's why, Kevin. If you follow anything, whether it be in traditional news or alternative news, there is talk about, and it's real life, the rate of mortgage applications, the number are falling. And to that point, if a business is set up, all businesses have overhead. If they don't get the cash flow, their overhead will eat them alive. And that's exactly what this means. So that's a precursor to what other things happening. So unless something changes and rates drop or something that affect, there's a challenge, because the buyers out there looking for houses, new builds or other, they're just not there. And house prices are dropping for the moment. Go ahead, Kevin.
Yeah, and the house prices were up so high. And then when the mortgage rates go up, people go, well, wait a minute. When I first started looking at this house, I could afford it. Now my payments have gone up another $700 a month. And, no matter what that number is, that can shift debt to income ratios over a point where the banks just can't do those loans. So it's really that combination of all things. But once again, when you navigate your way through this article, I'm going to point out some highlights from it here. It just came out August 19th. It's not surprising, because just like the last crash, it's the most aggressive lenders, the ones with the loosest restrictions, that fall first. This time around, that's not big banks. Big banks have a tendency to get bailed out. We saw that last time, and that whole phrase, which everybody hates, is "but too
big to fail."
Thank you. I knew you'd have it. Too big to fail, and we, the taxpayers, had bailed those banks out. And this time around, and you're going to see this in this article, and you're going to see the PowerPoint that I'm going to show you here, that's not going to happen, because these are not banks that are doing the majority of loans in this country right now. And it hasn't been since 2016, by the way. Most people think when I get a loan to buy a piece of real estate, I go to a bank. Well, non-banks have written more loans than traditional banks since 2016. But to your point, before I start going through the article here, I showed this, but there is a chart that I showed, again, for everybody just listening on this. In this article, there's a chart in there, U.S. mortgage market slowing down, and it shows the home loan application volume dropping from 2021 August to 2022 August. And that's pretty much a straight arrow
Kevin,
going
let me
down.
interrupt here.
Yeah.
The folks that are just listening and not watching, detail where it was in August of 21 compared to where it is right now in terms of the actual fall. I see where it's above 700 and it drops down to what, 273 over, what is that, that's a year period of time, right?
Exactly. Yeah, over a year period of time. Yeah. So that angle, what is that? A 45 degree,
Right.
Yeah, angle going right down like a. It's pretty dramatic. Looking at the overall volume. Now I'm not sure. This is probably 700,000 to 273,000 would be my guess, but it's pretty dramatic. I mean, if you were to look at this chart and go, "What's happening to market volume?" You wouldn't guess and go, "Well, it's kind of hovering." No, it's been steadily dropping down. Really, in just looking at those simple numbers there, it's dropped more than half.
Yep, and that's from the Mortgage Bankers Association, so it's not some outlier.
Mm-hmm. Yeah. Let me point out some highlights on here. So the first paragraph starts, the U.S. mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates. And the wave of failures that's coming could be worse since could be the worst, I should say, since the housing bubble burst 15 years ago. So again, I know there's a little, grabbing headlines and getting eyeballs on your articles. Those are how the bills are paid. But that's a pretty frightening statement that they have there. I don't know if we'll see such a thing there, but there are vulnerabilities because here's the problem. And I'm just going to highlight some of these things. The biggest banks, after the last crash, they pulled away from mortgages. They felt that with all of the new restrictions, their profit margins were limited by the Dodd-Frank Act. They still had responsibility to lend in all neighborhoods and such. And they just said, you know what? The profit margin versus the risk isn't really worth it for us. So they started laying off a bunch of people in that part of their banking business. So what happened was these independent bankers, so-called non-bank lenders, started to come in and take that business volume away. Now, when property values are going up and they don't have to operate quite as restrictive as the banks did, there's a lot of money to be made. So these companies jumped in and really ran with it because they can also highly leverage what they are doing. They have on average 5% of their own money in these deals. 95% is borrowed, which makes them poorly capitalized. So if people are paying, so these non-bank lenders have what's called warehouse lines of credit, and they have to make payments on that every single month. So as they're doing loans and money is coming in, they can afford to pay those. But what happens when the default rate goes up, which it's doing right now? They run into problems. What happens on the other end if the warehouse line of credit lender, because of inflation, says, we need to bump your rates up on this next review? You're not getting the same deal that you did last time. They can get in trouble and they can tank. And that's what the rest of this article really is all about here. Let me put out some more highlights here. Let's see. And failed. Yeah. So one of the bigger companies here, First Guarantee, they talk about in this, they filed for bankruptcy and they failed to make their loans payments to the warehouse lines of credit. They just didn't have enough for bond money or anything else. They had line of credit, couldn't pay it. So they are going belly up. Now, they had a line of credit just by two banks. So here's the thing. Flagstar Bank and Customers Bank gave warehouse lines of credit to this non-bank lending entity, First Guarantee. They can't pay it. So what's going to happen is these outliers here in the non-banks that default, banks are not out of trouble because banks have been giving them the money to do the loans. So the domino starts to play. Now, employees will also get hurt. In this article, First Guarantee had 600 employees. They did $10.6 billion in loans last year. Because of this, before bankruptcy, they had fired, it says in here, 471 out of 600 employees. That's not good. And this is just one entity here that is doing this. If I missed something there that you see, Dave, let me know.
I just want to throw this out there. So many of the folks on this call either own paper or looking to buy paper. Now, some of those folks, and it's just not this company, it's others that are out there. If people lose their jobs, how do they pay their loan?
Mm-hmm.
So I'm just putting it out there to be a devil's advocate.
Mm-hmm. Yeah. And again, rates going up. My article just refreshed there with an ad. Here's what happens. Just like the last crash, I mentioned it's the lenders that take on the most risk. So there's a hierarchy here. With these non-bank lenders, some of them can still get Fannie Mae, Freddie Mac, Ginnie Mae backing, which means federal government backing, just like banks can get. Even though they're non-banks, they can qualify on certain ratios, certain loans, etc. But there are some loans that don't fit that category that these lenders do. And then there's more aggressive lenders that don't get federal backing at all. Those are the most vulnerable. That's what happened in this case. There was no federal backing for this company, First Guarantee. They had to lay off 417 people out of 600 and then declare bankruptcy. They're done. The bondholders are going to get paid first. Remember, debt holders, that's one of the reasons we like to buy debt. Debt holders, when things go bad, debt holders get paid first. The equity owners in this company are done. They're not going to see a dime out of this whole thing in that one company. But what happens when this goes to other companies? That becomes the issues here. So once interest rates start to climb, lending volumes shrink across the industry, according to a company that monitors all of this. And that's when these folks run into trouble. There is no funds here. They can't get GSE funding. So they are very, very limited. So what happens when one company goes down, these entities that do warehouse lines of credit, they start to look everywhere. I mean, wouldn't you? If you were a company that lent hundreds of millions of dollars to these lenders and you saw, a couple of these have gone into bankruptcy. First of all, you would have known about that. If you have hundreds of millions of dollars out there, you would have known about that way before it happened. But what are you going to do? You're going to tighten your range. You're going to limit those lines of credit. You're going to possibly increase what they have to pay, or you might do a margin call saying you all only have 5% of your money. Our agreement says if you reach this point, you have to double that. Well, these companies don't have the cash to do that. That becomes the problem here. So the warehouse lenders in this industry seem to be extremely on top of things in this downturn, unlike '08. This is a change, said the bankruptcy attorney Mark Power, who's representing creditors in the first guarantee bankruptcy. They're making margin calls quickly. So this is the attorney who's representing this entity that is going into bankruptcy. So he's seeing that firsthand, that they're making these calls, and they're making these calls quicker now to stave off any crisis from going further, letting that domino fall even further here. So let me switch over to the PowerPoint here. And on this PowerPoint, I want to say this, and Dave, you know from doing all the State of the Industry addresses that I've done and all the years that we've known each other, I stay pretty much in touch with what's going on in the industry and do quite a bit of writing about it. And I know you do that as well. And one of the things that is really neat, at least for me, to go back and look at some of the things that I've done in the past and how they've related to today. And I got to say, this one's pretty spot on.
You know, it is, Kevin. What was old is new, and what is old is what is new is old. You and I were speaking earlier. There was a gentleman called Jack Miller, and he was an old real estate guru.
Well known, yeah.
Yep, and he'd seen 11 cycles, and he saved me in '07 as things were crashing. He said, you know, when a down economy, get into managing government property. So I did the REO agent thing, and it worked out well. It brought me back up from the bottom. But the net is, he has some letters out there, the Commonwealth, reflecting back on '79 to '83 when we had those high interest rates. And as I was at a virtual seminar this weekend with Bill Cook, he's basically saying those letters are parroting what's going on right now. So we've lived it. It's coming. You can't hide from it. It is what it is. You can put all the icing you want on it, but it's coming. It's there. But if you know what's coming, you can monetize it. It'll work out really well to be positive.
Yeah, a lot of people are making parallels to back then, and it's fairly easy to do, which is scary, which means it's got a higher degree of accuracy. If you can, if you take one talking line and say, I can connect that back to then, but this one's very different. This is multiple storylines of going, boy, this have we seen this before or not? And it all came with loose lending. That's what happened in the last crash, right? They just started, everybody had this thing of, well, everybody deserves the right to own a home, and let's just give money to everybody. Not everybody was ready for that. They set up so many people for failure on these adjustable rate loans and everything else under this guise of, hey, you've got the American dream of home ownership, and then we're going to raise your rates next year and then the year after and year after till you can't afford it, and then you lose the American dream. And that's what happened to so many people. So when money is too easy like that, getting all those loans of, no payment, no docs, stated income sort of stuff, no wonder we had a big failure. So after that happened, and this is the cycle that you were talking about, and Jack Miller and by proxy and everything else is, okay, so we learned from that. And there was a knee-jerk reaction. They tightened up all the lending. And then, of course, that tightened up the economy because housing is huge. When you think of all of the people, all of the industries, all of the materials that it takes to build a house and then magnify that across the United States, there's so many people and entities and everything else involved in real estate. That's why it's a key economic indicator. So when you tighten up lending to the point where nobody can buy, well, nobody's going to build either. You know, it's like, why would we do that? Nobody can buy. So they had to start making things easier. And that's where all these adjustments to the Dodd-Frank Act started coming in. And it got to a point where several years after the crash, they started these bad practices again on a smaller scale. Okay. But the seed started there. And I pulled up this. You can't see it, obviously, if you're just listening on this, but we're looking at a slide here. There was an organization called Neighborhood Assistance Corporation of America. They were doing live seminars for people who wanted to, you can see it on the bottom there, achieve your dreams events. Okay. This is after the 2000 crash. I wish I had the date on there. Maybe it's on the next slide here, but this is 2000. Let's see, 8, 9, 10. This is probably 2015, 16. I put this together in 2018. So this was happening either 2017 or 18. They were having events, and people would go to these events and get qualified for loans because right on the screen here, NACA, N-A-C-A, that's the Neighborhood Assistance Corporation of America, was doing loans, no down payment, no closing costs, no fees, no income limit, no need for perfect credit. Right on their right on their thing. So people would come to these seminars and get qualified under these type of loans. And although this was done on a small scale, this is how far back you can start to track this. So we went from really loose policy on lending to tightening it up probably too much, loosened it up again, and then it started going the other way again. And I've got another slide on there that talks about the steps and how to sign up and how to do that. They had 100 to 600 people showing up at those workshops and getting low interest rate loans and everything else. Hey, I'm all for home ownership, but I can tell you, being in this business long enough, I've seen people even in the seller financing world, David, which you are a big part of. I've seen people, investors, let me put that out. I've seen investors, novices typically, that don't know how to create loans the right way. They don't know how to pre-qualify somebody. And ultimately, they're setting that person up for failure. You've seen that. You're seeing it now, right?
I am. To that point, here in Phoenix, there are a number of flippers who are planning on getting X for a house. Oh, there's a supply chain issue with the rehab. The rehabs are taking a lot longer, 4, 5, 6 months, and they've got hard money loans on them. Values are dropping. One gentleman in the audience in Chandler, Arizona, just saw his house value drop from $800,000 to $650,000. He was crying about that. It was all free money. He's owned a home since '97, so it's like, I don't know what you're talking about. But my point is, that stuff is all part of what we're talking about here. So these people that are coming in with no money down are paying premium dollar. What's going to happen to them when they lose their job? Mm-hmm. And it's just cycling around.
Yeah. And if we're creating a loan for somebody, which is something that we do in this industry, we can acquire real estate at a discount. There's going to be more of it, apparently. And then we can turn around and sell it and finance it for somebody. But you've got to set them up the right way. You know, you don't want to put somebody into a deal that 2 months down the road, 3 months down the road, they can't pay again. You know, it's like, why go through that? You've got to do it the right way. And that's why the rules that this company had, no down payment, no closing costs, no fees, no income, no need for perfect, that is a no-win deal, because somebody's going to get stuck holding the bag on that loan. And if you're creating seller finance loan, that's going to be you.
Also, opportunity, Kevin, as it relates to hard money and these flippers. And the hard money guidelines are pretty loose based upon values. Values drop out, hard money lender is exposed.
Yeah.
Can't finish a deal, they're still going to make interest loans, or make their interest payments. As an opportunity, again, going to the positive side, a lot of those hard money lenders might want to just say, hey, I want to cut my losses here. You buy them out and you foreclose. So again, we're in the note business. That's an opportunity for notes down the road. That happened in '08 also. A lot of the hard money guys were dumping their loans just to salvage what they could. They didn't have the stomach to take it all the way to the end of foreclosure.
Oh yeah, I lived through that. I've gotten out of all of them, and I was desperately trying to get through the others, and I had to take 2 deals back that I did hard money loans on because the property values had just crashed, and there was nothing I could do but take them back and sit on them. Rented one of the properties, the other one I ended up having to tear down and take a loss on, and so it can and does happen, and that's why and that's, by the way, that event is one of the reasons that I started to study the market and research this stuff all the time, because I don't want to get hurt again, in that, and lesson learned, and that's why I stay on top of this. Okay. All right. I'm looking at another thing here. So for those listening on this is a Brookings Papers on economic activity. One of these exciting reports that nobody reads except for people like me. This is written by 3 Federal Reserve board members and then 2 University of California professors about the liquidity crisis in the mortgage market. Now, these slides, once again, I put together at the end of 2018. So that's when this report came out. It's so relevant to today. I want to go through this a little bit and tell you why that article in Bloomberg makes complete sense. When I go through this, you'll have a good understanding of what that is. So the first chart that shows here is the non-bank mortgage originations. It really started at a very low point. They were doing less than, if you look at the chart here, you're looking at just under 300 billion in loan originations for non-banks back in 2008. In 2016, 8 years later, they were over $1 trillion. So is that right?
Yeah.
Yeah. Over $1 trillion. That was 2016, everybody. And what's happened is that has continued to go up. So more of this is on the non-bank side than the bank side. So some people might think, oh, okay, well, we won't have a bank crisis. But remember, as I was pointing out, and I will illustrate coming up here, is banks are not out of trouble on this, which means we, the taxpayers and the government, are not out of trouble on this, because who gives the money to these non-banks? The banks do. Okay. They're the ones who give them warehouse lines of credit, them and a combination of investors. Okay. So non-banks back in 2016 originated about half of all mortgages. So that was the starting point where the lines started to cross here. They also, non-banks, did 75% of the mortgages insured by FHA and VA. 75%. Both shares are much higher than those observed at any point in the 2000s. Non-bank companies are vulnerable to liquidity pressures in both their loan origination and servicing activities. Now, again, this is in this report by the Federal Reserve board members and a couple of professors from University of California. This is their observation back in 2018. So much great information in this report and how it leads up to what's happening today. And there was so much information, I decided to break it into 2 parts. So this is going to be part 1, followed up by part 2. In part 2, we're going to continue right where we left off, go into the report, show you again where we are today, but most importantly, talk about the opportunities that all of this is creating. What magnitude, we may not know, but we do know that there is going to be some new opportunities, and we have to learn how to navigate that landmine field, and that's what we're here to do. That's why we personally consult with people to do that. So stay tuned for part 2. We'll pick it up right where we left off.